Okay, so super excited because there's always really great information. Laura has been in the lending industry for, I'm going to say 10 plus years and just leave it at that. However, what you've been specializing in is the down payment assistance programs and something really, really cool. This could be inaccurate, but I know that there's at least recently, at least two more people that have jumped on the dream funds. And how much was that, Laura?
It was up to 150,000, so or 20%. So we have one that hopefully is going into escrow today with Carlos. So
Oh,
ready, cross your
yay!
fingers.
And how much did they get? How much did they get awarded?
He is receiving at price 68,000.
68,000, you
Oh,
said?
he's 68,000.
Wow, that's incredible. Congratulations.
Thank you.
So I mean, it's not just that you have knowledge of them. It's just, I know one of the first times that we met, you were telling me about a family. You got them over 140,000, right? It was a daughter helping the parents buy the home, and so numerous stories, numerous success stories. So thank you so much for taking this time to jump in and give us this overview on whichever program you're going to talk about today. And I think you've done one session. This is the second session. We're probably going to do another one. So Laura, by the way, Laura is fully bilingual, which is super awesome because I didn't think you spoke a word of Spanish, but you're full and fluent, all the things. I know that the Spanish-speaking community really can take advantage of this. I'm going to go ahead and hand it over to you and to Megan to finish off the session. And then there will be a recording, and we'll go ahead and we'll push it out to anybody who wants to learn something really, really good and help people get into their dream home. So take it away, Laura.
Awesome. Thank you, everyone. There's a ton of programs out there, but I wanted to go over the basics of how to get the people into the programs, because it's not everyone's going to qualify, but it really, really makes that phone ring for you, and it makes you look like an expert. You'll see people posting online, we have this exclusive program, it's 3% down, but it's really not their program. They're just kind of claiming it. It's programs that are available to everyone. Now, there are some banks that have a specific ones, like the big banks, right? That's theirs. But generally, we can pretty much do everything that's out there. And let's see, bear with me here. I'm trying to get it to move forward. Oh, okay. So there's programs that are available on the city level, on the county level, and on the state level.
Laura, I'm sorry to interrupt. Did you want to share screen?
Oh, did it not share?
Not yet, no. On the bottom, the green share screen, and then we'll be able to see.
Is it on now?
Not yet. Oh, there we go. It's going. Perfect. Now we're on.
All right. So do not add tech expert to my resume. So again, there's programs on the city, on the county, on the state level. And what we do as loan officers, and we help the realtors do, is explore all of the options to see if we can layer them or if they qualify for more than one program, which is going to be the best fit for them. All right. So I jumped ahead, so there's assistance in the form of loans. There's grants out there, and there's also tax credits, which help them in the future to be able to pay less taxes, and can also be used as income because we're already thinking ahead that they are going to pay less taxes. And I don't know if any of you have heard that. It's called the MCC, the Mortgage Credit Certificate, and it allows you to qualify for a little bit more. Loans, they're generally in the form of a second mortgage with very low or no interest rates, where the payments are deferred or they're forgiven incrementally for each year that the buyer returns in the house. But the bulk of them are loans, and they do have to be paid back, and that's something that we let the buyers know up front. And please, if you have any questions, just feel free to chime in. Some of the loans have what's called a shared appreciation feature, which means that the homeowner pays back the original amount that they were lent to be able to purchase this home that they wouldn't have been able to buy without the help, plus about an average of about 20% of appreciation of the home. It depends on when they go ahead and sell that or if they refinance to pay it off. It can be a little scary for some people, but if you take a look at this next chart here, here's an example of a house that was purchased at $500,000. And 5 years later, they're ready to sell, they want to move up to a bigger home, or they want to refinance and pay it off or just cash out. So the home is appreciated to $640 at this point. And so dollars to begin with, the home is appreciated $140,000. 20% of that is $28,000. So they're going to pay back. So of the $140,000 that the home is appreciated, the homeowner keeps $112,000, and they pay back the $100,000 to the city or to whichever program, plus only $28,000.
I'm so sorry to interrupt. I think we're only seeing the first slide.
So I'm on my screen, I'm seeing the second slide on both.
Let's do this. If we stop the share and reshare, I think, do you have a dual monitor?
I do.
I think it's sharing the other one, the original. If we do share screen, the
Uh-huh.
one that's blown up, I think it's showing us the overview. If not, I think I have it open here. I can try it too here if that works. There we go. Now we see the chart.
Now you
Perfect.
see the chart. Okay. So this makes more sense here. Sorry about that. Thank you for letting me know. So here's a home that's appreciated from the original price of 500,000 to 640. We have 140,000 in appreciation. The homeowner keeps 112 and 28,000 plus the amount they originally borrowed goes back to the agency. So they end up keeping the bulk of that appreciation, and it's a good way for them to think is that people would never have saved up 112,000 if they didn't have enough to put 3.5% down. It's not likely that they would have saved this much up in 5 years. Do you see the next screen now? Income limits?
Yes.
Okay, so all of the programs have income limits, and the income limit, that's the maximum, and in a couple of cases, the minimum that a household can make in order to be eligible for assistance. And it would be easy if all of them had the same income limit, but every agency has a different limit. I'm going to share that information with you as well, and you can always reach out if you have any doubts about that, but they all have an income limit. Some of the programs are going to look at the household income, and others at just the applicant income. Another twist on that. Applicant income is you're only taking into account the income of the people who are going to be on the loan, the applicants. So you determine that borrower A and borrower B, they make 100,000 between the two of them. That's what we're going to use to compare it to what the program is saying that is the most that they can make. So we're just looking at the applicant income. You look at that, the limit is 120,000. They make 100,000, you're good. Other programs, the ones that offer the most assistance and most of the city programs, they're going to look at what's called household income. So they're going to look at the income of every adult. So anybody over the age of 18 that's going to live in the house, and to determine eligibility. So if you say, oh, there's going to be 5 people living in the house, 3 adults and 2 kids, but only the dad is going to apply. He's the only one that's working. So they're going to look at the income of the other 2 adults in the house. They may be earning cash on the side. They may have Social Security, all kinds of things, maybe child support coming in. So they're going to look at all of that, even if they're not going to be on the loan, and they're going to add that up and then compare it to their chart to see if this family qualifies for the assistance. So even if someone's not going to be on the loan, let's say you have a non-borrowing spouse who has really bad credit and wouldn't qualify, they're going to take that person's income as well into consideration. So here's an example of the income that they're looking for. And this is for the most conservative programs. So they're going to look at what's on your paycheck, what's on your tax returns, if you're earning royalties or bonuses, if you have a business, if you have a bank statement with a lot of interest, they're going to look at that. Any kind of benefits that you're receiving, disability, VA compensation, unemployment, welfare assistance. People don't have to declare welfare or alimony. They don't have to use that to apply. But if they're receiving it, the program's going to take a look at that and count it towards their limit. So they're going to take a look at all of that. So these are just examples of income that they're going to look at. Not every program is going to look at this, but some do. So how are they going to know? Right? Some people say, well, just don't tell them. How are they going to know that we're making this extra amount of money? So they're going to review 3 to 6 months worth of asset statements from every adult that's going to be living in the house. So again, if you're saying there's 5 people that are going to be in the house, they're going to run a credit report on all those people, and they're going to look at their asset statements to see if there's money coming in, because that's a sign of income. But most people have direct deposit these days if they have any kind of benefits. It's good to kind of figure that out up front. And so what determines a household too? How are they going to, if you want to qualify a program and you want to say, oh yeah, I have 4 family members who really don't work. They don't earn any income. They don't have any debt. I'm going to throw them on there so I can qualify for the program. So you have to show that you have there has to be a good reason for why everybody's going to be living together all of a sudden. Or either you can show that you've already been living together, or maybe now your parents are older and they're going to be coming in to live with you. So that makes sense. Some people put a lot of dependence on their tax returns. So if it shows up on their tax returns, we can use those. But again, they're going to look to see if they're earning any income if they're over the age of 18. So these are the tips of things that I struggled with when I started that would kind of trip me up a bit until we figured it out. So the income calculation, we as loan officers calculate income in the most conservative way, because that's the way the underwriters look at it. So if they see that a person's earning overtime, they're going to average it out for 2 years, and they're going to take the most conservative number. Whereas the programs are going to take, what did this person earn in the last 3 months? And let's say they had a really good 2 weeks, maybe it was around Christmas time and this person was working a lot of overtime. They're going to look at all that money that they made during that time and project it out. So their calculations may be a little bit different than ours. And I'm going over these not to discourage you, it's just to let you know how to do it so that we can move forward. So they're going to take 3 months of checks and they're going to project it out over 12 months. And I always like to order a VOE up front, which is a verification of employment, to see if the employer is putting on there that this person is going to receive a raise, maybe next month or in the next 2 months, because they're going to take that into account. Because maybe they could not put that the person's getting a raise. There's different ways to kind of do it. So those are for the most conservative programs. For the programs that only look at the applicant income, they just use whatever we calculate. So that makes it super easy. So whatever we put on there, they don't care who else is going to live there. They don't care how much money they make. They're just going to look at the income that the underwriter has accepted or that we're presenting them. So that makes it much easier. Anyone have any questions? That's how we calculate the programs. And so I'm going to go over now some of the programs that are out there in our areas. So it's a ton of information. I'll share this with everyone, and then we're going to recap next week as well. There's a program called the Daisy Grow program, and it's a 2% grant that's forgiven after 3 years. So I really like this program because the borrower only has to come in with 1 to 3% of their own funds and the closing costs, and they do have to have reserves. But it is a grant, and a lot of people just love the word grant. They want to know that the money's going to be forgiven. And 3 years is not too long to stay in a property for the money to be forgiven. There's no mortgage insurance. So when you see people advertising, I have a 3% down, no MI. So this is one program that we could fit them into. And it's a conventional loan. So it's no mortgage insurance, 30-year fixed conventional loan. It's available here in LA and Orange County. So it's not available in San Bernardino or Riverside, but it is available for these 2 counties. And we can use this for units. A lot of programs don't allow units because they don't want anything that has an income producing component. So this one could be for single family, for condos, PUDs, and 2-unit properties. And the rent from the second unit can help them to qualify. So I primarily have used this program for units in low to moderate income areas. And I'll show you why. Minimum FICO for this program is 660 for a 1% contribution and 640 for 3% assistance that's going to be forgiven. They do allow non-occupant co-borrowers, which a lot of programs do not. Another reason why I like this program, so you can have somebody to help you to qualify. Their debt to income ratio is 45%. So it's kind of the average of what programs allow. There's some that allow more, some allow less, but this is pretty much the average. And here's your maximum loan amounts. Not the sales price, but the maximum loan amount. So for 1 unit, for people who need assistance, it's a pretty good deal, $766,550. And for 2 units, you can go all the way to $921,500. And here are the income limits for LA County and for Orange County. But there's a really cool feature about this program that if the property is in a low to moderate census tract, and I can share how to find that information, or you could always reach out, then there's no income limits. So you don't have to worry if your client makes $300,000 but hasn't been able to really save. They could still qualify for this program if the property is what's called in the low to moderate census tract. So what they're really trying to do is they're trying to build up home ownership in kind of the low to moderate income areas. So again, this is called the Daisy Grow program. And they look at income by applicant income. So they don't care about how many people are going to be living in the house. Another cool feature about this one is they don't have to be a first-time home buyer. So they qualify if at the time that we're going to be closing the purchase transaction, they don't own another primary residence. So they could have owned a house and they sold it and they're using the proceeds to maybe go here, or they were on title to someone's house. That's considered home ownership. So this does not stop them. They don't have to have that 3-year period without having any ownership at all. There's no prepayment penalty. So if they decide after a year that they don't want to live in this property, they can sell it. The grant that's forgiven after 3 years, what they'll do is they'll prorate it. So they'll prorate the amount that they were lent and divide it by how many years are there, and then they pay back that amount. But it's not a prepayment, it's just the grant part that's reduced by the time that they were in the home. They do allow seller contributions. Super important now that we have to figure out how to find ways to pay for the buyer's agent. Any questions on the Daisy program? So CalHFA, it's one of the most popular programs. It's available throughout California, so there's no specific to a certain area. So it's all through California. This one has a little bit higher minimum credit score. It's 660 for FHA and 680 for conventional. The types of properties are single family, condos, PUDs, manufactured homes. So no units on this one. Loan limits, they don't have their own particular loan limits. They follow whatever the county limit allows. And this is the program that has one of the most generous income limits. So for our higher earners, in LA County, 194, Orange, 255, and Riverside, San Bernardino, up to 193. So a lot of families who can't afford in LA County or Orange that are moving to Riverside, San Bernardino, really generous income limit for those that don't have much saved up to purchase. And a good thing about this one, they only look at applicant income. So whatever we determine, there it is. So this program is also the one that administers the Dream for All, and it's super easy escrow. We can close this within 30 days. No extra time is needed. We have our underwriters that review the file, and whatever we say, CalHFA accepts. So the assistance amount is anywhere from 2 to 3% of the loan amount and at 0% interest. And also they offer an additional assistance of anywhere from 3 to 3.5% at 1% interest. So there's two types of assistance that they provide. Their rates, when you just take the assistance amount to cover the minimum down payment, so if you compare that to somebody who's just coming in with 3% on a regular conventional, you're going to have about a half a point savings. So CalHFA has 3 different tiers of assistance. They have a maximum debt to income ratio of 45%, up to 50% with a 700 FICO. So they're also generous with their debt to income ratio. They do have to be a first time home buyer, which means no ownership interest in the past 3 years. What I've seen that's stopped people from being able to use the program is maybe their parents put them on the house title just for security. I see a lot of families do that. They say, eventually my son's going to inherit this house. I'm just going to put him on the title now. So technically that person is now a homeowner, and this program doesn't offer any exceptions. You own a home, so you won't qualify for this program. They do not allow any cosigners unless they're going to live in the house. So they wouldn't really be cosigners living in the house, but they don't allow any non-occupant cosigners. So that was the CalHFA program. And again, that's the most popular one that we use. It's kind of the easiest ones to qualify for because it has a higher income limits. Next one, if anyone has any questions, is the LAHD, which is the LA Housing Department. Some of you may have heard of the LIPA or the MIPA program, and LIPA is low income and MIPA is moderate income program. And this is just for the city of Los Angeles. So not for the unincorporated areas, not for the county areas, but just for the city of LA. I do a lot of these programs, or this one in particular. They offer up to $161,000 for assistance in down payment and for closing costs. And the loan that they provide you is 0% interest. It's not forgiven, and this one has that shared appreciation feature that we went over earlier. The way I explain it to my clients is focused. I do share about the 20% appreciation, but I focus more on the 80% that is going back to them. And also to, when they go into the program, is to start to think of an exit plan, because you don't want to wait 30 years to pay them back the 161 that they lent you, because your appreciation will be much higher in 30 years than if you try to do this in 3, 4, 5 years. And that's the plan that I've done for all of the clients that I've purchased with this program. It's been a starter home and they've moved up to something bigger. And they've used that appreciation to buy a bigger home, put down a bigger down payment, and kind of minimize what they're sharing with the city. For this program, the borrower has to come in with 1% of their own funds. We kind of calculate the maximum that they qualify for and let them know they need to have that money in their account, and it has to be seasoned for at least 2 months. Minimum credit score is 660, and they also have some pretty generous ratios. Maximum is 45% and up to 50% with compensating factors. And compensating factors are a credit score of over 700, if they've been on the job for more than 5 years, if they have a couple of months of reserves in the back. So it's pretty easy to get them up to 50%. So the property, one of the harder things with this one is that the property that they're looking at, it can't be tenant occupied. So there can't be a tenant in there. It has to be vacant, or the owner has to be in there. And if there's any illegal or unpermitted structures, they won't allow it. And so in LA, there's a lot of garage conversions or patio conversions. So if you're looking at these properties, you really want to make sure that there's no illegal or unpermitted structures. And they make no exceptions on this. Single families, condos, and PUDs, they do not allow non-occupying co-borrowers. So everybody that's going to be on a loan has to be living in the household. And they do look at the income by household income as well. So here are the loan limits for the low income program, LIPA. So they have loan limits of $973,750 for a single family home, and for condo and townhouse, a little under $594. And if your client is a moderate income borrower, so their income's a little higher, then there's no limit to, it's whatever they qualify for. There's the tiers of this. So the LIPA, the low income program, if you have a family of 4, they can't earn more than $110,950. If you earn up to $166,000, then we would go to what's called the moderate 150 program. So there's still assistance available. It just would be less. So the first tier is up to 161, second one is up to 115, and the third one is up to 90,000. Still pretty good amount of assistance that's available. So if you're going to say there's 4 people living there, we got to make sure that we take a look at all of the income. Hopefully it's just 2 parents and the kids, or one person and 3 kids. Any questions? No, I keep looking this way because the other camera's that way. I'll go over one more and then we'll save the rest for next week. There's a program called Cal Home, and I work very closely with a nonprofit that administers this particular program. They're in Montebello. They're called, the name is Montebello Housing Agency, and they offer up to $75,000 in assistance towards closing costs and down payment. I forgot the down payment there. The assistance is at 3% simple interest. So the interest every year is calculated off the original $75,000, so it's not compounding. No payments are required until repayment is triggered, and repayment is triggered if they find out that you've turned the house into a rental, if you've sold the house, or if you're refinancing to cash out. So they do allow you to refinance to lower the payment. And this one's available in LA, Riverside, or San Bernardino County. Right now, it's more of a viable product in San Bernardino and Riverside. Not available in Orange County. Buyers have to come in with 3% of the sales price of their own funds. So if we think they're going to qualify for this, we want to get them to start to save up a little bit for the contribution. They do not allow non-occupant borrowers. They do have to be a first-time home buyer, so no home ownership interest in the last 3 years. And here's their income limits. So the thing with this program is their income limits are pretty low. They're going by 80% of the median income in the county. So this is for LA County. So for this one, a family of 3 can't make more than $99,900. So I have found this program to work really well for people who have a lot of kids. And they look at household income. Their ratios are a little bit more restrictive than the other programs. They only allow you up to 38% for your housing and up to 45% total. I've been working with them with the board, to try to see if they would change it to kind of mirror the one for the city of Los Angeles, where they go all the way to 50%, because they are similar products, but the board is old and stubborn, so we're still working on it. All right, we'll stop there. We'll start with the next one. And if anyone has any questions, you're free to call me, or I can go over these in more detail if you want in person. And thank you.
Thank you so much, Laura. Does anyone have any questions at all? Oh, the dog is so cute.
Oh.
Very cute. Anyone have any questions for Laura? All right. Don't forget, next week, Friday, same time, we will be back on here. Please invite other agents as well. Anyone is welcome. This recording will be up by tomorrow. So we will see you all then next week on Monday. And I hope you all have a fantastic weekend. And thank you again, Laura. We really appreciate it.
All right. Thank you.
Thank you, guys. Bye.
Take care. Bye.